everyone. Welcome back to Financial News. Today is March 21st, 2022, and I'm Ron Jankowski with Channel 4 and Palos Heights, and my co-host is Paul Munichel from Ameriprise Financial. And Paul's going to give us an update what took place last week, and I have a last-minute information that came in from Ameriprise to share with the viewers. Paul, let you take it away.
Thanks, Ron. Today I'm going to talk about corporate earnings despite everything that's been going on in the world lately. So let's just kind of dive right into it. Despite the volatile backdrop, corporate earnings estimates, they have been resilient. I know it's hard to believe that the first quarter of the year is approaching its end, but investors and the world for that matter have endured a volatile landscape over the first 3 months of the year, highlighted by Russia's invasion of Ukraine, inflation at 40-year highs, and a sharp increase in interest rates and interest rate expectations. But now on a positive note, COVID conditions appear to be improving, but so too have they in the past. Also on a positive note, reported S&P 500 earnings for Q4 were also strong, ultimately showing actual year-over-year earnings growth of 31% versus the 24% that was projected. As such, the 6% decline in the S&P 500 index itself year to date has been entirely the result of valuation adjustment. Now, the trailing PE of the S&P 500 has declined to a recent 21 from its 2021 ending level of 24.4. Additionally, despite the concerning developments that we've already spoke about, aggregate earnings expectations for Q1 and the full year of 2022 have remained resilient. It's normal for current quarter estimates to decline during any given earnings season, and that's been the case for this quarter as well. However, since the end of January, full year 2022 EPS estimates have expanded by $3.06, and 2023 estimates have expanded by $2.57. So despite all the troubling news that, again, we've been talking about every week, Ron, earnings are still hanging in okay, at least so far. Well, we're constantly monitoring them, but that data speaks for itself.
Yeah, it does. Excuse me. And as of this morning, information we got from Ameriprise, U.S. stock index futures are flat this morning after the index gained about 7% off from last week's lows, rather.
We had a strong market last week,
yeah.
And today's not surprising. It's kind of searching for direction. Does it want to keep going higher, or are sellers going to creep in and drive it down? We'll have to wait and see.
Now, the markets in Asia closed mixed in a narrow range, while European markets are modestly higher at midday, and the U.S. Treasuries yields are higher with a 10-year at 2.20%, while the 2-year is up to 2%.
Nothing out of the ordinary there.
Bad news, WTI crude is 4% higher after losing about 6% last week, and it's just fluctuating up and down.
Yeah, I mean, that's to be expected. There's a lot going on out there, and as we talked about week after week, uncertainty is difficult, and it drives prices higher oftentimes, and who knows, we'll see which direction it's going to go this week.
And lastly, Bitcoin futures are down 1.3%, and gold is down 0.2%. Now, the year-to-date index returns, you talked about the S&P 500 is a minus 6%. The Dow Jones is a minus 3%, and the NASDAQ is down 11%. Pretty much what has taken place last week.
Yeah, I mean, that's improved. Last week's show you reported much lower numbers. We're still negative across the board in those three indexes on the year, but getting a little closer. The Dow Jones is only 3.3% away from being positive.
Right.
So
It could reach there, would be in a positive territory rather, and we'll see where this takes us
Yep.
next week.
exactly.
Thank you, Paul. Stay with us. We are going to bring you a show called Your Money. Stay with us, and you will hear a topic that Paul has to share with you. And we're back with Your Money. Thank you for staying with us. This is an interesting topic. How do you effectively manage today's market volatility? And Paul is going to give us some guidance on this. Paul, I'll let you take it from there.
Thanks, Ron. I'll do my best. I've got 5 steps to hopefully help the viewers at home just do that, manage the volatility that we've been experiencing. So this year, 2022 has presented challenges for investors, with stock markets experiencing significant volatility and bond markets showing unpredictable movement. Now, much of this can be attributed to external events. The most notable triggers are Russia's invasion of Ukraine, an extended period of higher inflation, and a shift in monetary policy by the Federal Reserve. Times like these can cause anxiety for investors as you watch markets move up and down, sometimes dramatically, in a day. Now, it's natural to wonder whether it's time to make changes to your investments. Before you do so, it's important to think about your finances in the context of the broader picture and seek advice from a professional who can help you evaluate what actions, if any, you should take. But today, I'm going to give you the 5 tips to maybe get you started. Step number 1, don't let daily events overly influence your decision making. It's easy to become overwhelmed with the headlines of the day, particularly if seemingly bad. News is piling up and having a negative impact on the markets. Keep in mind that we've seen many periods where markets suffered sharp downturns. Yet historically, markets as a whole have always recovered any ground lost during the short-term setbacks. Headlines, they come and go, but building an effective long-term strategy should remain your primary focus. Step number 2, reassess your risk tolerance. So if you're feeling uneasy about market volatility, you may need to take another look at the level of investment risk with which you are comfortable. Periods of market volatility are often a true test of the ability to withstand temporary setbacks to your portfolio. Another consideration is your time horizon. So for example, if you are within 5 years of retirement, you may want to consider scaling back the level of risk in your portfolio to protect against the impact of a major downturn occurring at the wrong time. Maybe just when you need the money for retirement. Moving on to step number 3, stay properly diversified. Once you're determined your risk tolerance, the next consideration is diversification. Maintain an appropriate balance of stocks, bonds, and other types of investments. In addition, make certain you don't have a concentrated position. As a rule of thumb, no individual holding should represent more than 20% of your asset mix. This includes company stock you may hold in your workplace retirement plan. And sometimes even 20% is too high. You may look to lower that even more. Step number 4, continue or expand systematic investments. While volatile markets can be concerning, they shouldn't impact your ongoing investment plans. If you make regular contributions to your workplace savings plan or other accounts, it's best to maintain those investments. If markets go down, your regular contribution will purchase more shares of the investment. That could benefit you over the long run. If you have the ability to save more through systematic investing, don't be hesitant to boost those amounts you stock away regularly. And last, number 5, review your strategy with your financial advisor. It can be helpful to discuss your financial situation in the context of today's markets with your financial professional. They will be able to help you assess your current positions, if your portfolio carries an appropriate level of risk, and whether there may be investment opportunities you should consider today. Having a conversation about the best way to approach today's markets can make a difference and can help keep you on track to achieve your most important goals.
Wow, that's pretty good. But you know, Paul, when you put in a sizable investment and the market has volatility, downturn, and then you think, what did I just do? And you have to look at it as, I don't need that money. Leave it for the long term. It'll hopefully correct, and usually it does. Sometimes short term, other times long term. And you really need guidance from an advisor, because you can make a mistake so easily, thinking that your investment was wrong to begin with.
Right, and market volatility, like it or not, it's always going to be part of markets.
Yeah.
In any given year, there's something that causes volatility in the market. There's news that causes turbulence and cause market swings. So market volatility is normal. Sometimes it's worse than others, but volatility is always going to be around. So as an investor, you got to be able to stomach that. And again, like you said, you got to speak with your advisor to make sure you're taking on the right level of risk and you can stomach that volatility.
And the volatility is more meaningful of concern when you're in retirement,
Right.
because you're thinking that you're going to have some gains and they turn out to be losses. Well, they won't be losses if you are using proper strategy, and if you don't have the strategy, you need a professional to guide you on that.
Right, just because your account statements are down doesn't mean that money's lost.
Exactly.
It could come back. If you sell it or take action, that's different. But volatility is going to cause markets to go up and down, and it's going to be part of the markets going forward.
Paul, if there's any question from the viewers, can they call you?
Yes, then call me directly at 708-226-3412.
Okay, well, thank you, Paul, and Ameriprise Financial. And for myself, Ron Jankowski with Channel 4 and Pale Sites, we wish you good investment day.